Many traders think you need to be constantly winning throughout the month to actually be profitable, but the truth is you only need 1 or 2 A+ trades to actually trade full time. It's not about catching every valid trade. In fact, that is far from the truth. I'm able to generate consistent 5-figure days from a single trade, just because I know how to spot my A+ setups. So in today's video, I'm going to be sharing my checklist of every single A+ confluence that I like to see before getting into a trade in the live markets. An A+ trade is going to come from an accumulation of smaller confluences, so just seeing one of these is not going to be enough to consider the setup A+. But once we start stacking these confluences, we can really start to increase our risk to rewards and our win rate alike. Market structure is always going to be a great place to start. Not only is it going to be an extremely important indicator on where the market wants to go, but it is fortunately very easy to determine on our time frame. So let's go through exactly how we're going to do that. A really easy way to determine this is going to be, are we making higher highs and higher lows consistently? If I mark them out, we can clearly see that this high is higher than this high and this low is higher than this low. I don't want to make it too simple because it is a really easy concept, but these are essentially going to be traits of an uptrend. Therefore, we are in favor for buys and we are going to be looking for areas of demand. I'll also chuck in an example of a downtrend just so you can visualize it a bit easier. And it's just going to be the opposite. Are we making lower lows and lower highs? If I mark them out once again, this high is lower than this high, this low is lower than this low, and it really is as simple as that. These are going to be traits of a downtrend. Therefore, we are in favor for sells. And as you can probably guess, we are going to be looking for areas of supply. And that's really as simple as market structure needs to be. Next, let's talk about our level of liquidity. And this is going to be in the form of a small swing of retracement, as we can see just here. I'll also chuck it into a supply, just because once again, it's really good to see. But let's just go through the demand example, just because it's cleaner. So for our first point, we want this swing to be 2 or more candles. One candle liquidity is not going to be valid since it doesn't make a visual enough swing to actually be certain that a strong level of liquidity is sitting below there. Next, this swing needs to happen within a valid distance from our zone. Last but definitely not least, it's really important to mention that this swing does not touch our zone at any point, because if it does, our zone is instantly going to be invalidated. After we form this level of liquidity, we want to see that liquidity's high broken. For a demand example, that is. As we can see here, it is actually already happened. If I mark it out, the swing high that formed liquidity is broken to the upside. This is going to be great to see because it is just going to be another break of structure to the upside. And this is just going to confirm market structure in our favor. We are making a higher high by breaking this high, which is a trait of an uptrend, as we just discussed. Next on our list of confluences is just going to be making sure that we are not reacting from any previous key levels. Key levels can be in multiple forms, so swings or consolidation. As we can see here, it is a swing high. If we were to come up to this area and only match it, then there is a chance that we may just change bias. Since it may align with a higher time frame swing or a higher time frame resistance, we really just don't know. What we want to see and what we can see here is a convincing break of this level. If we were to zoom in, we can see that we are making clear candle closes above, which is just extremely intentional price action, and it's showing what the investors want to do. Now, let's actually talk about our zone itself. And the main difference between our zones is going to be its strength, how strong actually is our zone. And this is going to differ, but it's going to be between 2 main variations. One is going to be the size of the zone, and number 2 is where it's formed. Let's start with the size of the zone. As we can see here, seeing a zone that is smaller in size in proportion to our setup is going to be great. If I marked out our entire setup, we can see that our zone is super small. Now, if we were to quickly go to a larger zone, we can see that there are a lot more potential prices where investors could be looking. We know that investors want to get in at some point here, but we really just don't know where. And if we were to compare it to our previous zone, we can see that it's like 4 times bigger. A smaller zone is going to minimize the chance of fakeouts by maximizing our chance of getting the great price on our first entry into the zone. There is just going to be far less chance that we miss that original price on our first wick in. So that's pretty much going to be it for our first variance of zone. But as I said earlier, there is going to be a second, which is where our zone is formed. Our zone should not be formed as part of the market structure to the upside, part of that straight line, as I say. What we really like to see instead is our zone formed on the bottom of a swing, as we can see just here. And this is just going to go straight back to market structure. If we are looking for a demand, then we should be in an uptrend. And in an uptrend, we want to make consistent higher highs and higher lows. Therefore, this should be the lowest point that price wants to go before continuing back up to the upside. Once again, bullish is literally just going to be higher highs and higher lows. If the market is actually uptrending, then it's not going to want to break this low, since that would form a lower low, which is simply just not going to be a trait of an uptrend. Now, before we talk about entries, let's actually talk about how we want to come back to our zone. So the movement back to our zone after we break liquidity's high, so if we go back a couple of points, it's going to want to be very clean, or in other words, in a straight line. Now, this is either going to make or break the current market's bias, and I'll go over what I mean a bit more in a second. Now, there are essentially going to be two ways that price can come back to our zone. One's going to be great to see, then one's going to be not so great to see. For this example, I have a supply. I'm really trying to drill it into your heads that it's important to see both. But as you can see, price coming back to our zone after breaking that liquidity's low. This is a supply example, so we're looking for a downtrend. Therefore, we want to keep making bearish market structure. So after we break that low, it comes back up really, really cleanly. This is just going to show clear and very intentional movement from investors. And it is also going to leave imbalances on the way if there is enough volume. As we can see here, there is a fair value gap. We don't need to look too much into those, to be honest, but it's just once again going to be another confluence because price consistently likes to fill imbalances within the market. So now we are just really starting to stack confluences. So that's going to be what we do like to see. What we don't like to see is counter structure. So in this screenshot right here, if we were to come back down to our zone, then that would be really, really clean and straight movement. So it has potential to be an A+ setup. But instead, what we see is just really, really choppy price action, of which forms lower lows and lower highs. We come up and match this high at the top, which forms a level of resistance. And then from then, we just make a lower low, a lower high, once again, another lower low. And as we've discussed, these are traits of a downtrend. So it is doubtful that we will continue up after this. If we are looking to go upwards, we want to be in an uptrend. Why are we showing traits of a downtrend? And as we can see, we invalidate the zone straight away before continuing extremely bearish. Now let's get to the point that I know we all want to talk about, which is going to be our entry models. The entry models that I use are just going to be a way to see the active investors, since we heavily rely on rejections from our zone. If we don't see rejections, then there is going to be no entry. And this is going off the fundamentals that rejections literally equal investors. Therefore, no rejections is just going to equal no investors, which are the people that we're trying to ride the back of. So we have three main entry models that we use to capitalize on this, and they are all going to be used in different scenarios. So let's start off with our most commonly used, the directional close. And it is literally as simple as it sounds. All we're going to do is wait for a close in our direction. For a demand example, we're going to want to go upwards, so we're just going to wait for a green close after we wick into our zone. And that is really as simple as it is. We're just going to put our stop loss on the deepest wick into our zone. And as far as TPs go, you can have these at liquidity or use the optional TP rules that I have over in my Discord. It's really important that we do not close inside of our zone, since this is not going to show enough rejections that we want to see. Therefore, if we close inside of our zone, then it is completely going to invalidate the setup for us. I'll just quickly go through a supply as well. Just once again, it's great to see. For a supply, we want to go downwards, so we're going to wait for a close in our direction. That's just going to be a red close. After, we wick and do not close inside of our zone. As you can see, the volume is insane after we get this confluence. The entry price would just be here. We've shown enough convincing involvement from the market movers, therefore we can be a lot more confident that we will continue in that direction. Now let's move on to our more complex entry models. They're only going to be more complex because there are more rules attached to them. All these two are essentially going to be doing is trying to predict the directional close. This can lead to better entries in volatile markets, since we're not going to run off before we get our entry. And for flip entries, we can use different time frames to try and predict future movement. I'm not going to go too deep into these since I've mentioned them in previous videos, and I also have completely tailored videos on these in the Discord down below. So if you're really trying to learn everything about this strategy, I would recommend it. But let's just quickly go over the basics. So a break of candle is going to be best used in volatile markets. And these entry models are just named very well. All we're going to be doing is waiting for a break of the highest point of the previous candle. That's a lot of words to literally just say right there. It's important that we break the top wick of the previous candle and we're not just looking at the body. So once again, this is just going to determine our entry price. We get in right there with the same stop losses as every other entry model. It's just going to be on the lowest wick into zone. And since we're in an uptrend, we can easily just put our TPs at that high. Now for some of those smaller rules that I was talking about. this is going to be preferable to see in the final half of the candle, since it's simply going to have half the amount of time to not give a bullish close. If we were to break this previous candle's high near the start of a new 5-minute candle, then it could just be a lot of random volatility. It's not to say that we are going to continue in this direction. Once again, we're just going to try and be predicting the bullish close, which can lead to potential better risk to rewards, but it's also going to come hand in hand with a lower win rate. I say potential better risk to rewards because there is still a chance that directional close is better than this. We can't predict the future. We are just trying to predict that there's a lot of volume in the markets, and I don't want this to run off without me. Next, let's talk about flip entries, which get a little bit more confusing. These can once again be used in volatile markets, and it's going to be preferable to see on a new higher time frame candle. If we go and look at the higher time frame, I believe this is the 1 hour, we can see that almost every candle has a significant upper and lower wick. Therefore, if we were to form this candle on the 30-minute or the new 1 hour candle and come straight down as we see here, then that means we have not formed an upper wick yet. And like I said earlier, we can literally just use this to try and predict the future. There's a lot of volume in this candle, so we've formed a pretty good lower wick. But we have no upper wick yet. So we can take an extremely educated guess and say that we want to go upwards and form this. Therefore, we make another lower wick, and once we flip from bearish to bullish, we are going to get our entry price with the same stop loss concept as the other entry models. This is once again just predicting the bullish close, but can lead to much better risk to rewards with a lower win rate attached to it once again. This is what I'd call our riskiest model. I say riskiest because it's not technically the riskiest for our gain. With the lower win rate, it's just going to come more rewards per trade. So it can still lead to a great long-term return. But I'm simply just not going to be preaching it as much since I've done the most testing. In fact, decades of testing using the directional close. It's what all of the backtesting results over in the Discord is using, and is realistically going to lead to the most consistent gains in the long term, which we should all have in mind. We're not trading for money right now, we are trading for the freedom of the future. That's more or less everything that I wanted to mention. Once again, I go through all of these concepts much deeper over in the Discord, so if that's something that really interests you in learning, then that will just be down below for you to join. There is also a very quickly growing community of traders that are going to be talking every single day that is completely free for you to join and learn from. And I'm active in there quite a lot. If not, don't forget to subscribe so I'll just see you in the next one, and like if this helped you in any way. See you next time. Peace.